So with all that being said, now I'm going to talk about the actual market. Those are, tough things to do. It's psychology plays a big role in everything we do in life, and having the right mindset is what determines, long-term successful investors versus not successful. All right. So it's been a brutal year, a really, really tough year for the old diversified 60-40 portfolio. It's been the worst 3 quarters to start a year since 1974. Here we are, and here's 1974. Combination of things going on, right? We're coming off of all the excesses and stimuluses of last year coming from COVID, and now with all that stimulus and excess, we have inflation. And so now we're worried about a Federal Reserve that is increasing interest rates. So the bond side of the portfolio is getting hit, and then we're worried about them over tightening. And inflation will affect us and put us in a recession, which affects the stock side of the portfolio as well. So we're not getting any kind of relief from either side of the portfolio, and we're getting hit on both sides of the table or of the coin here overall. But you can see generally those really bad years are followed up with positive returns. Those negative returns don't last forever, and it is followed up with positive returns, overall. So how did we get out of all the other bear markets, the last 9 bear markets? Well, the Fed intervened and accommodated. You can see all the ones in the green, bear markets, that the Fed actually lowered interest rates. What makes this bear market difficult is that we are in a bear market where the opposite is happening. Interest rates are increasing at the same time, which makes it particularly painful overall. And the Fed seems really bent on completing their agenda of getting inflation, under control, and even if that means at a detriment to the economy. And this is just a quote that I found amusing. Some people may not find it that amusing, but Jerome Powell is like the guy that missed all of his homework assignments the whole year. And then as a treat for the teacher on the last day of school, he comes in and he's written a rock opera and he's going to perform it. And basically, he failed the test last year, and now he's doing everything he can to make up the grade. And that's from our good old friend Josh Brown on CNBC. But it's really, the Fed does have a habit of, they have to speak strongly because they have to be taken seriously and they can't be seen as wishy-washy, but they do pivot. They always pivot. Some of these charts that I'm going to show are going to be difficult when you just look at them, but I'm just going to explain them very, very simply, and hopefully you can kind of get the gist of it. The blue line is the interest rate on the 10-year Treasury, the yield on a 10-year Treasury note. And the gray area is when the Fed is tightening. So when the Fed is raising interest rates, okay? So we can see there's peaks and then interest rates come down. There's peaks, interest rates come down over and over and over and over again that correspond with Fed tightening cycles. But generally yields start to fall before the end of the tightening cycle. So here we are right now with the Fed very aggressively tightening. And now we're at 3 to 3.25. They said that they want to get to 4.5% as their terminal rate overall. But are they actually going to get there? Or are they going to slow down? I think the market is trying to kind of sniff that out. The market has a good job of kind of looking at something and seeing, well, maybe this may happen, and let's not be as bearish as we could be. I think that's what happened in June. The market went down in the June lows and we had a really powerful rally. We got a good inflation number. We thought maybe the Fed would roll over. Well, then the next month, inflation number wasn't as good. The Fed came out really strong language. That rally got busted up. Now we hit our lows again. We're retesting those, and we've had a really couple good days here overall, because I think the market is sensing this as well. Inflation is still coming down. Bank of England has reversed course. The Bank of Australia didn't raise rates as much as expected. The UN is saying, hey, the dollar's getting out of control. US, you need to calm it down a little bit, or just at least pause for a little bit of time, because the dollar is too strong overall. So I think that's why the market is sniffing this out here as well. But the Fed has a habit of, and this this next page. This is real complicated, but I just want you to focus in on dark gray is when the Fed is lowering interest rates, white is neutral, and light gray is when they're tightening. And there's a pattern here, and it basically goes easing, neutral, tightening, easing, neutral, tightening, easing, neutral, tightening. And they go back and forth, basically easing, neutral, tightening, actually neutral, easing, and they go back and forth over and over and over again. And right here during COVID, they dropped the interest rates to 0. They didn't raise any interest rates last year. And so now there is nowhere to go but up, basically. And now they're in this tightening cycle. But based on history, their next step is more of a neutral or to easing. That's what happens, over the course of time. And the market obviously likes that. This just shows you when the Fed is neutral, the average market gain per year is 8.68%. When they're easing, it's 10.33%. So are we closer to that than maybe a lot of people anticipate? Possibly. Really depends on if the inflation handcuffs come off and some of the pressure, that they're getting right now. Okay, this is the graphs get continuously more difficult as I go on. So I hope that everyone gets a cup of coffee and gets ready for this one. This is going to be a tough one, but I'll just basically, these are all the cycles. And historically, when the Fed starts to tighten, the market doesn't correct before the Fed tightens. And the market's still pretty resilient overall. So these are tightening cycles. And yes, fast tightening cycles don't do as well as slow tightening cycles. But the cycle that we're in right now is out of the norm, where we actually had a correction occur. This is the current cycle, well before even the first Fed rate hike. And, over the course of time, it's continuously tracked lower, and we're right at our support levels right now overall. So usually things kind of let up at the longer we get away from the first Fed rate hike, because we know eventually that's going to come to an end. The question is how much damage is going to be done from what they're doing. I mean, they're trying to control the demand side of the economy, which they're doing by raising interest rates. That affects loan demand, that affects capital, investments, and that's working some part. But the other side is the supply side, which they can't affect overall, and we just need some more time for that to kind of be alleviated to help out with the inflationary standpoint. This is an internal model that we have that basically zone in on here. Can you see my mouse? I think you can see my mouse. Okay. So zone in on here. We were in a high inflationary pressure environment. This has come down considerably, and we are about to enter a more low inflationary environment based on our inflation timing model. Generally, when inflation peaks and comes the other way, it does come down fast and quick overall. And when we are in this lower part of the graph here, the gain per annum is the highest, where the gain per annum is 13% per year on the Dow Jones when we're in this low inflationary pressure environment. So we are getting there, and there is definitely signs of cooling off inflation. Supply chains are easing up. We can see that here we're hitting a peak, and the projection is to come down pretty considerable. COVID, the zero COVID policy in China doesn't help things. The Russia-Ukraine war doesn't help things. But even with those things, supply chains are easing because demand is getting more in line. There was a lot of demand imbalance last year. All that pandemic savings, the consumer was spending through the roof, the durable goods demand was through the roof, things weren't getting to where they were supposed to be getting, but now things are easing off overall. We're still a good ways away from our target rate of the 2%. I mean, the 2-3 year expectation is we do get back within that range, but we are rounding the corner and coming back down. And keep in mind that the market generally, it doesn't care about good or bad news. It cares more about, are things getting better? Are things getting worse? So on the inflation front, I would say things are getting better. I think what is mostly spooks out the market right now is the Fed overdoing it. And that is obviously a risk. From a valuation standpoint, this is just saying on a trailing basis, we're below our mean. The excess has been removed in terms of overvaluation in the marketplace. Even on a forward earnings basis, the excess has pretty much been removed, overall. We're in a much better place from a valuation standpoint. This is a pretty technical one. I'll do my best to explain it, but basically, there are signals in the market for potential market bottoms called breadth thrust. And when 90% of stocks have a 10-day moving average above their 10-day moving average, that's a buy signal or breadth thrust signal. It's not always accurate, but they tend to group together during market lows overall. And we've gotten a ton of them this year. I think some of this has to do with algorithmic trading, a lot more prevalent than ever before. But looking backwards, these signals, there's been 36 of them, okay? And 35 of them have resulted in the market being up 253 days later. So it's kind of these big conviction rallies is there might be something to it, overall. Now, this first breadth thrust this year happened in March of 2022. And if we don't get about a 12% recovery, by the end of the year here, then this would be a failed breadth thrust. But we've had 3 more since that point in time, which means there is money out there. There is money there's always money out there to look for bargains and look for deals. I mean, when people sell something, they're always going to look to get back in. I mean, money is always going to gravitate towards some type of asset to get some type of return. So are we getting enough of these conviction rallies overall? I mean, there's some preliminary signs of that. Pessimism is really high right now, which you may think that's a bad thing, but that's generally what sets up really, really powerful rallies coming out of market lows. Pessimism generally is really, really high at market bottoms. That's why it's really difficult to time, because everything doesn't look good at market bottoms. But again, remember, it's not about good or bad. It's whether it's getting better or getting worse overall. So this is a setup of a low pessimism for at least a good tradable rally. When the numbers come from here back into this range, that's when our best returns are, which is about 20% per annum. So this blue line is a cycle composite of basically 1-year seasonal cycles, midterm cycles, and 10-year cycles. And we've followed it fairly closely overall because the trend is more important than the level. Generally, what you have is weakness in the summer months, which is the blue line. This orange dotted line is the current market so far this year, where we hit a low in June. We bounced off that, and then we retested a low. We're retesting the low right now. But seasonally, from October to December on midterm years are good years. So at least we have a kind of a cyclical seasonal backdrop that's more favorable or more conducive for an overall market rally. So if you can think back of Marty McFly and Doc Brown of going back to the future, so this is kind of some things that we look for. We look for analogs that could explain, some, market behavior overall. And they're not perfect, but, they give us some maybe reasoning or rhyming of what could occur. So our first analog is 1962. And in this one, there's some similarities. In 1962, we had a first-term Democratic president, President Kennedy. There was a midterm year in 1962. They had supply chain issues. Sound familiar? We had geopolitical crisis, Cuban Missile Crisis back then. We obviously have geopolitical issues right now. The market, oh, I went out of focus. I don't know what happened. Oh, there, I'm back. So there was a lot of fear of a recession. So it tracked pretty closely. June lows, a rebound, and then a retest, but then the end of year rally. Ultimately, recession was avoided. 1963 was a good year, and that was it. There was a fear of recession, but it didn't actually happen overall. Now, the next analog is 1973. Now, 1973 was a company with high inflation, concerns about the economy, so stagflation, overall. And it tracks pretty closely here as well. Again, the blue line is 1973, and the orange dotted line is where we're at currently. So again, we had a low in June, a rebound, and in October here, we're basically right at the retest level, at the support level, retesting those lows. It broke through. There was an Arab oil embargo at the time. Basically, oil got cut off from the US, and the US went into a recession. The market went lower the next year overall. Now, one major difference in this 1973 versus what I think we have now is, if I drew another line over here of inflation, we've seen inflation peak and start to come the other way. As the market was coming down here in 1973, inflation kept on going up, and it was continuing to go up, at that point in time. So I think that's one of the main differences between this analog, is that we are getting inflation peaking and coming down on the other side. I think what ultimately determines the market outcome of where the lows are, which is very, very difficult, is if we go into a recession, how deep recession that is. Some people say we're in a recession, some people don't. It's a debate in the community right now. We had 2 negative quarters of GDP, the first 2 quarters. This quarter is actually looking like a positive quarter, according to the Federal Reserve Atlanta, is predicting a positive third quarter GDP. And the National Bureau of Economic Research actually says we need broad weakness across the economy, which includes labor, to actually have a recession. And obviously, we don't have a labor issue. And so GDI, which is gross domestic income, because everyone who wants a job can get a job, is still, income's still going up. So there's this debate, are we in a recession? Are we not in a recession? And ultimately, I think that'll be determined at some point in time. But the bond market is saying that there could be a recession. The 55% of the yield curves are inverted, meaning the short end of the yield curve, short-term rates, are higher than long-term rates. And we spiked above this, but now we're back below this. So we're right at the support levels. We're right at the inflection point. Does this market hang on, or are we going lower? And that's why I think we're seeing some good rallies here, overall. So we're set up on a seasonally basis to possibly for this rally to continue. So these are the headwinds. Obviously, the Fed, be helpful if the Fed kind of took its foot off the neck of the economy. The Fed aggressive tightening and a potential mistake. Still at high inflation. There's a geopolitical risk, but almost there's always some type of geopolitical risk. Earnings expectations are falling. However, that could be the setup for earnings surprises on the upside. Tailwinds, short-term, very, very pessimistic overall. That sets up very powerful rallies and sets up bottoms of markets. Cyclically, we're heading into a nice season, and inflation is cooling. Oil's getting lower, housing is definitely cooling off, and supply chains are recovering. So that's all I got for the market. I'll